So bubbles form when a combination of a few things happen. Firstly, the fuel for a bubble is usually cheap money.
Okay.
So for some reason, money becomes cheaper. But low price money on its own doesn't necessarily create a bubble. That's one thing. The second thing that usually provides the source of a bubble is some new story, usually a new technology. And I don't mean technology in the terms of electronics. I mean something new to the world that wasn't around before. And that's what creates a bubble. So new technology that everybody wants to put money into because they believe they will get rich. And at the same time, money getting cheaper. Those two things together and some good storytelling invariably turn things into a bubble.
Welcome to the Teaminvest Wealth Builder podcast, where we help you build smarter wealth and make more confident investment decisions. Welcome back to this week's episode of Teaminvest Wealth Builders podcast. Today with me, I have Howard Coleman. Now, Howard is the co-founder of Teaminvest, and he is an expert in this field. He's been doing it a long time, and we've just got the opportunity to be able to learn from some of his wisdom. So thank you for joining me again, Howard.
Pleasure to be here again.
Awesome. So today we're going to focus on a topic, bubbles. Now, if you've been around the investment industry or anything to do with finance, or even listened to the news, in all honesty, you will have heard the term bubbles. You know, are we in a bubble? That sort of thing. So, Howard, firstly, to start off, what is a bubble?
Well, there's no absolutely clear definition. It's not like you can say it starts exactly there and ends exactly there. But a bubble in financial markets really means where something becomes overpriced largely because everybody gets excited about it and its price goes into the stratosphere such that any rational person looking at it says, I would never pay that for that. So if you want to put it in perspective outside of financial markets, if you think in terms of, I don't know, say, buying a car, if suddenly, for some peculiar reason, cars kept going up in price without the rest of the rest of the world suffering inflation, and it got to the point that a car, ordinary four-door saloon car, was $500,000, you'd say that's in a bubble. And so where the bubble starts is not that easy to see, but it's always very recognizable in hindsight.
Right.
And the hindsight usually comes with painful experience. So bubbles have a terrible habit of ending surprisingly to the people who are involved in the bubble. And they used to be called a mania of crowds. So if you go back in history, they didn't refer to them as bubbles. They referred to them as a mania of crowds.
Okay.
So what would happen is people would get enthusiastic about something. That would cause other people to get enthusiastic about it, who talked to their friends, which caused other people to get enthusiastic about it. And therefore, the enthusiasm took hold of itself and it became what they used to call a mania. So the most famous one in modern Western history, there are many older bubbles than that too, what we now call bubbles, but the most famous one in modern history is, of course, tulips. The tulips in Amsterdam, where this new type of plant that was very attractive and could be made in all sorts of different colors, bulbs of tulips went up and up and up in value till eventually some tulips were almost as expensive as a whole house.
Oh, wow.
So one tulip bulb would virtually buy you a house. A few tulip bulbs could buy you a house. And of course, we all know what happened. It all came crashing down. Now, usually, I think the more important thing, though, is to see how do bubbles originate. Then at least you can recognize one when you're in it.
Yes.
And you can't in advance predict when it will end, but you know it will end if you're in one. So bubbles form when a combination of a few things happen. Firstly, the fuel for a bubble is usually cheap money.
Okay.
So for some reason, money becomes cheaper. Interest rates going down is one example. That makes money cheaper. Huge amount of money flowing into a country because they're exporting something that becomes more needed in the rest of the world.
Okay.
That creates a bubble. So the oil producers in the 1970s got extraordinarily rich, and that created a bubble of assets in their countries. I lived in South Africa when the gold price went up, and gold was our biggest export. And all of a sudden we had everybody in South Africa appearing much wealthier, buying nicer cars, building newer houses, etc., than they were before. So the one thing you need is fuel, and that's low-price money. But low-price money on its own doesn't necessarily create a bubble. That's one thing. The second thing that usually provides the source of a bubble is some new story, usually a new technology, and I don't mean technology in the terms of electronics. I mean something new to the world that wasn't around before.
Okay.
Tulips. Nobody had those kind of pretty flowers before. No, roses couldn't be grown in that many different colors. And if they could, it took many, many more generations to get them to change. So here was something new. Canals, railways, the telephone, the radio, television, new kind of phones that you could put in your pocket instead of the ones that had to be stuck to the wall or on top of the desk. Anytime there's the internet, of course, obviously, anytime there's a new technology, it enables people to paint a story which can easily create a mania.
Okay.
So if we go back to, say, railways, it took a long time to get from, for instance, London to Manchester. So if you had goods in London and you wanted to trade with somebody in Manchester and you know they needed your goods, it was a several days journey by a wagon to take your goods to Manchester and several days for the wagon to come back. Now, somebody comes up with this idea of a railway line. And all of a sudden, everybody believes the way you can get rich is to own a railway line. Why can you get rich to own a railway line? Because the first person who puts in a railway line gets rich. Now, everybody else wants to have a railway line. Suddenly, instead of there being one way to get your goods from London to Manchester, there's suddenly 10 railways or 10 canals or whatever. Don't take those as being exact numbers, but you know what I mean. Everybody copies it. Take aeroplanes. When the Wright brothers first flew, this was really exciting. It was news all around the world. It took days to get there, for the news in some cases to get around the world, but it was news all around the world. By 20-odd years later, there were 2,000 aeroplane manufacturers in the United States.
Wow.
2,000 of them. Today, in the whole world, for passenger aeroplanes, there are only a handful. And I mean, Boeing and Airbus is virtually most of it. There are a couple of much smaller ones like Embraer and a Chinese one and so on. But what happened to all of them? All of those became capital killers. But an enormous amount of money got put into all those aeroplane manufacturers because it was the new thing.
That was going to be the next big thing.
Absolutely.
Right.
Same thing with all the other technologies. Now, of course, we've got AI. Everybody has to put money into AI because it's the exciting new technology, and that's what creates a bubble. So new technology that everybody wants to put money into because they believe they will get rich, and at the same time money getting cheaper, those two things together and some good storytelling invariably turn things into a bubble. Now, when you're in the bubble, what should society do? If there's already a recognition that there's a bubble, and then we'll talk about what's going on in Australia, if there's already a recognition that there's a bubble, what should you do? You should say, well, let's be more cautious what we put our money into. Let's make money more expensive, not cheaper. But the exact reverse happens because everybody's so optimistic. After all, my neighbor just got rich. And, I know my neighbor's nowhere near as smart as me. So if my neighbor just got rich, I should be super rich. I mean, really, he's not very bright, or she, whatever. If they can do it, I can do it. So optimism spreads. And the moment optimism spreads, caution goes out the window. So everybody has to invest in this. Did you hear about so-and-so? He just got rich buying into whatever it is, the latest technology, whether that was railway lines, whether it was canals, whether it was tulips, whether it was telephones, whether it was cars. There was another one I forgot. There were many thousands of car manufacturers. There aren't many thousands today. Yeah. And of those thousands of airplane makers or car manufacturers or telephone makers or whatever, a small number in the end proved to be fantastic investments, tiny weeny number, and the vast majority of them end up being capital killers.
Yeah.
Now, that's not too dissimilar to buying a ticket in a lottery. A very small number of people make a lot of money when they win the lottery.
Yeah.
And the vast majority of people contribute the money that they make at the end of the day when the winners are announced. Everybody else is a loser. And that's really what happens in bubbles. Thousands of people put money in, and when do they put money in? When everybody else is already enthusiastic. In other words, too late. If you knew in advance this new technology was going to create a bubble, the smart thing to do would be to put the money in before it got talked about.
Yeah.
That by the time it reaches the media and it's been talked about in the media and all your friends are talking about it and the share prices of the companies doing that are going up already and everybody's saying you can't lose by being in whatever it is, that's when all the dumb money gets in.
It's too late.
Far too late.
You've missed the boat.
You've missed the boat.
Yeah.
Now, you may get very lucky, the same as you may get very lucky winning the lottery. But, we all know that lotteries aren't designed for the average punter to make money out of them. They're designed for a big contribution to charity or some other good cause or government coffers, where everybody pays in the hope that they will make money. Hope is not a good strategy.
No.
So at the moment, we're in a bubble. If you look at Australia, there are a number of bubbles that we're in. Number one's a housing bubble. It used to, throughout history, cost people somewhere around about 2.5 times to maybe 5 or 7 times, depending whether there was a boom on or a tough time in the economy, to buy a house. Annual salary times annual salary. Now, in Australia, it's the last figures I saw, they may be slightly wrong, 13. Now, even if it isn't 13 and it's only 10, it's more than it's ever been at its peak.
Yeah.
This is the highest it's ever been. Take share prices. In all the years that I've been an investor, I have never, ever seen a company that had been consistently profitable, so not just a one-night wonder, something that had been consistently profitable, trading on a PE of more than 100. I can find a couple of dozen of them trading on more than 100 times earnings today.
Wow.
Now, if we just put that in perspective, imagine I came to you, Kerry, and I said, I've got this business. It's not listed on the stock exchange, but I've got this business and it makes, I don't know, $1 million a year. How would you like to buy it from me for $300 million? You'd say, are you crazy?
You'd laugh, yes.
It makes $1 million a year. It would take me 300 years to get my money back. And then I say, no, but it's growing. So the second year it'll make 1.2 million. And the following year it'll make 1.44 million because it's growing. And you say, well, even though I can't work that out in my head, it just is pretty clear to me that it wouldn't take long to figure out I'm not going to live long enough to get back the money I'm putting in. And when a company's on a PE of 100, you're effectively, as somebody said in 1929, about 6 months before the big crash, that with these newfangled, they were then new, they're not new anymore, discount cash flow valuation models, some people are not only discounting the rest of their lives, they're discounting their children's and their grandchildren's lives too, because the PE's got so high. And so we've got stocks or shares in a bubble, not every share, not every company on the stock exchange, but a hell of a lot of them in an astronomical bubble like we've never ever seen before. We've got house prices in a bubble. In America, they've got bonds in a bubble. So the question is, where does it go from here? Now, the third thing you need to make a bubble sustainable and why they go on for a while is a belief that this time is different. And the moment you start reading comments from supposed experts saying, yes, but this time it'll be okay because, we're in really serious trouble.
Yeah.
And the media is filled with justifications as to why house prices should be so high, why the stock market should be so high, why you should own Commonwealth Bank even though it's at a ridiculous P for a bank, why you should own companies that are on Ps of 100 because they growth companies. Well, yes, but if they'd have to grow at a speed that they would own the whole world economy. Some time ago, I had not a Teaminvest member, but somebody approached me at an airport. So I'm sitting in an airport waiting for a flight. Somebody walks up to me and says, "Aren't you Howard Coleman? I've seen you on TV." And I always know what's coming next. And they say, usually, "Can you give me a tip?" This person didn't say, "Can you give me a tip?"
Okay.
I was quite relieved. He said to me, "Do you know, I don't know why you've never talked about so-and-so company." And he gave me the name of the company. I said, "Well, I don't know it well. It doesn't pass our filters in Teaminvest." He said, "It's doubling in size every quarter." I said, "Right. How much money does it make at the moment?" And he gave me a figure. And I said, if it's doubling in size every quarter, that means it'll be 1,000 times its current size after 10 quarters. Actually 1,024, but let's call it 1,000. 1,000 times in 10 quarters, that's 2.5 years. It'll be 1,000,000 times its size in 5 years. It will be 1,000,000,000,000 times its size in 7.5 years. At that stage, it will be bigger than the entire world economy in 7.5 years. Is that practical with what it does? Could you imagine that particular company doing that particular thing being bigger than the whole world economy, which of course is impossible, in 7.5 years? And he said, "Well, it's a good investment anyway." And that's a sign of, again, a bubble.
Yeah.
It's different this time. The logic of what I explained of the size it would be doesn't matter. Maths doesn't matter anymore. The size of the world economy doesn't matter anymore when we're in a bubble. So the Mississippi land bubble in the 1700s, the tulips in the 1600s, the 1820s or so with the canals, the railways, 20 to 40 years after that, and all the ones we've had in the last 100 years, including 1920, leading up to 1929, have all been similar things. But if you look at house prices in Australia today, and you look at stock prices in Australia today, they're in a more extreme bubble than 1929.
Wow.
Now, that doesn't mean every company on the stock exchange is. And yes, we do have better regulations, so there are fewer dishonest businesses. But only 1/3 of the companies on the stock exchange in Australia make a profit. 2/3 don't. So those 2/3 are effectively worthless, but are valued, inverted commas, on the stock exchange at some number which sometimes is $1 billion. Andrew came up with this amusing comment at one stage that why are they called unicorns? They talk of companies being unicorns if they're worth $1 billion. And Andrew said, because unicorns are mythical. They're not worth $1 billion. They're really dogs with a cone or on their head or an ice cream cone on their head.
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
So the next thing is to say to yourself is, well, if things are in a bubble, A, how should I invest? And how do Teaminvest members invest? And secondly, what should I avoid? And what probably comes next? So I'll start with what comes next and then go to how you should invest.
Okay.
Bubbles don't always end with a crash.
Okay.
So 1929 is remembered because there was a crash. The tulip bubble is remembered because there was a crash. The Mississippi land bubble is remembered because there was a crash. But for every bubble that bursts, there are several that deflate slowly.
Okay.
So in other words, instead of the mythical pin hitting the bubble, if you think of a balloon, the bubble lets its air out because you didn't tie the knot tight enough, and the balloon goes psst over a long period of time,
Okay.
sometimes several years. So those two bubbles, we don't know in advance which it'll be, by the way.
Okay.
And usually the pin is not something somebody expected.
Okay.
The Great Depression was caused by tariffs. It wasn't caused by a stock market crash in 1929. The stock market crash in 1929 made a number of rich people poorer. And then tariffs put in the United States by Smoot and Hawley to try and bring money into the United States to have the rich people not get poorer, caused other countries to put tariffs against the United States. So ships would arrive in docks in the United States and couldn't unload because they didn't want to pay the tariffs. So they couldn't take American corn back to Europe because the ship was now full because it hadn't unloaded. So the American farmers couldn't sell their corn and their various other agricultural products which they'd been selling to Europe. And trade froze, and everybody had no income. So the farmers who all were expecting to sell their corn and pay back the bank now couldn't pay back the bank. So the banks went broke. Because the banks went broke, the people who had money in the bank lost their money in the bank. So some years later, you now had everybody suffering, when originally the only people who were suffering is the people who owned some shares. And their share prices went down in 1929. So bubbles often pop for completely unrelated reasons. The one in 1973 popped because a war broke out in the Middle East and the Saudis and OPEC refused to sell their oil and bumped up the price of oil dramatically. Now, nobody predicted that. In 1929, before the bubble burst, one of the best-known financial experts at the time in the United States, he'd been a governor of one of the banks for a number of years, said that stock prices had reached a high plane from which they would never fall back again.
Oops.
That didn't turn out to be terribly right. And all the other bubbles, same thing. So I remember in 1999 giving talks on profiting from the internet, and at that time AOL was the most valuable company in the world, only for a very short period, but for a short period it was the most valuable company in the world. And I said, this is a case of the emperor has no clothes. It's hardly making any money in terms of profits, and it's got this astronomical valuation. No, Howard, you don't know what you're talking about. It popped. AOL a few years later was worth nothing. But as I say, Kerry, the important thing is most bubbles don't pop. They deflate slowly, so we don't recognize them. And when I say they deflate slowly, could take 2-3 years, could take 10.
Right.
And share prices or house prices can go down for a very, very long period of time. Japan was a perfect example, 1989. It took till only a couple of years ago for the Japanese stock market to reach the prices it was all that many years ago. gold reached $800 an ounce and it could never go down. There was a shortage of gold in the world. There was always going to be a reason to own more gold. And it reached $800 an ounce in 1979. And you could only make money by owning gold. And I got sucked in after saying all along it had been a bubble. But now everybody was making money out of gold except me. All my neighbors were making money. I lived in South Africa at the time. And I thought, gee, I'm sounding like a fool doing the opposite. The only way you could own gold other than in jewelry in those days in South Africa was Krugerrands. So I bought 10 Krugerrands, paying $800 each. I spent $8,000. That cost more than the Mercedes-Benz I bought, brand new, top-of-the-range Merc, a couple of months earlier. Okay? It took something like 30 years again for gold to reach the same price that I had paid for my Krugerrands. By then, a Mercedes was $100,000 or something. So bubbles can, but by the way, the important thing I was going to say, it didn't happen suddenly.
Yeah.
It wasn't that in 1979, suddenly the gold price plunged 90%. It went down a fair bit in one hit, 10, 15%, and then it gradually drifted up and down, sort of, but mainly down over the years. And each time it went up a little, I'd think maybe I should sell my 10 Krugerrands. Then I thought, no, they'll go up more than that. Then it went down some more. And eventually I left South Africa in 1989, 87. So 7 or 8 years later, got far less for my Krugerrands than I'd paid for them, and they were still even less another decade later.
Oh, wow.
So bubbles usually deflate slowly. So how do you invest when there's a bubble? Well, a house has two values. One, a place to live that you like, presumably, otherwise you wouldn't have bought that one. And two, possible investment. Well, I wouldn't invest in property at the moment because we're in a bubble.
Yeah.
And it's whether the bubble deflates slowly or whether a pin arrives that pricks this bubble and causes it to deflate suddenly, I don't know, but I do need to live somewhere. I might as well live in a house I own, I like, and that I can change to suit me and do work on it as it suits me.
Yeah. Will
Will it always be worth more than I paid for it? No. The first house I bought in Australia, I sold for $150,000 less than I bought it for. Happens.
Yeah.
The house I currently own, I doubt that I'll sell it for less than I bought it for because I bought it for only about 20% of what it's worth today. So will it drop 80%? Probably not, but I'm sure I'll sell it in the next few years for less than I currently could get for it. But if I sold it, I wouldn't have anywhere to live. I'd have to buy another house. I might as well stay in the house I'm in that I like.
Yeah.
The same thing with companies that you own on the stock market. So from a Teaminvest point of view, the market isn't one homogeneous thing. The same as I mentioned earlier that I've never seen so many companies on P's of more than 100. There are also a lot of other companies that make profits every year, grow their earnings, have high return on equity, don't have debt, that are trading on P's of 15 or 20. Now, 15 or 20 may not be super low. There have been times when some companies traded on P's of less than 10. But at 15 or 20, you're not going to go very wrong. If you, in fact, if you put it in perspective, if you buy a company at a P of, say, 10, that has a 10% earnings yield. In other words, it earns 10 cents on every dollar is why it's a PE of 10.
Yep.
On a 20 PE, it's got an earnings yield of 5%. Both of those are better than I can get in the bank. So there's nothing wrong with that. But on a 100 PE, it has an earnings yield of 1%. On a 300 PE, it has an earnings yield of 0.3%. So I tested this on a group of friends at a dinner party one evening. This is a little while back, about 6 months ago. So we were about 12 of us around a dinner table. And I said, tell me here, would any of you, if I came along and I said, I got this fabulous investment, it's going to give you a return of 0.3% per year. Who's interested? They all laughed. Yet people buy a share on the stock exchange on that basis because they hope remember, hope is not a good investment strategy. They hope there'll be a bigger fool later. The same as I read in reading up many years ago, a couple of books on the tulips in Amsterdam. They asked one very successful business person who traded with the East, bringing spices from Indonesia and was quite wealthy. They said, but if you consider how much you know about what is good business and what isn't, why did you buy some tulips at such a high price? He said, because they were going up in price, and if I bought them at this high price, I was absolutely convinced there'd be a bigger fool than me tomorrow or the following week that I could sell to for a higher price. I just got the timing wrong. I was the last. Now, that's the problem in bubbles, that everybody thinks they'll be smart enough to get out before it's too late. But nobody rings a bell to tell you it's the end of the bubble. If we think the Cinderella story, and Warren Buffett's often talked about this, nobody tells everybody in advance that, other than Cinderella, that the carriage is going to turn into a pumpkin and the horses are going to turn into mice. But when it strikes midnight, it happens. But she just wanted one last dance. And that's what generally happens with bubbles. So as an investor, as Teaminvest members, what we look at is we look at what are all the best run companies on the stock exchange. Having found those, you say, which are at reasonable prices. And often those two are not the same set. You may find 50 companies that are great businesses, but only 10 of those 50 are at reasonable prices. The other 40, if you find as many as 50, you say to yourself, gee, I'll put them on my watch list because they're great businesses, and I hope one day that Mr. Market, for some funny reason, gets unhappy with them and batters the price down. Now, I had a personal experience of a perfect case of that. When I first met John Price, this is before we started Teaminvest. I met John Price, and that's why we started Teaminvest, because I met John. And John, in a demonstration of his software, which we use still today, modernized a bit, but all the principles are the same, only the look's different. John demonstrated a company I'd never heard of before called ARB Corporation.
Okay.
I'd been investing for ages. I'd never heard of ARB Corporation. It looked absolutely fabulous. Every year its earnings were higher than the year before. Every year its revenue was higher than the year before. It had a great return on equity. It had zero debt. It looked absolutely fabulous. So I thought, I've got to buy some of these. And I bought some, a small amount, and thought, gee, since I've cashed up a couple of other things, I'm going to buy more of this. And a week or two later, an article appeared in the Sydney Morning Herald, if I remember correctly, maybe in the Australian, but I think it was there for Sydney Morning Herald, that there was a proposal that the government was going to ban four-wheel drives from the cities in order to reduce carbon emissions. And ARB's share price went down. And I bought a hell of a lot more of them, paying at the time $2.35. And at that time, it was a PE of less than 10. That's 18 years ago. Today, the share price is somewhere in the high 30s. It's paid in the time so much in the way of dividends that I've had my money back in dividends many times over. And I just got lucky. It wasn't anything particularly brilliant on my part. John had identified ARB. I read all about it for a few days. I read the annual reports, thought I agreed with everything John's software showed, and I thought I want to own some of that. But it was expensive. I wasn't going to buy much of it right now, and Mr. Market helped me out by making it cheap. And markets do that all the time. So if we look at the market overall, it's in a bubble.
Yeah.
If we look at individual businesses, some of them are in a super bubble. Others are not in a bubble at all. A year and a half ago, you could buy, for instance, JB Hi-Fi for $45 or $42, I think it got down to. Now it's over 100. What's it done in a year to have doubled? Nothing. It was too cheap then. It's probably too expensive now. Somewhere in between was probably about the right price. So as a Teaminvest member, what we're looking for is great businesses that we've checked thoroughly and we understand them well, and we know what their risks are and we know what their moats are, and currently trading, which may only be today, it may change by tomorrow, currently trading at very low PEs relative to their past history. Now, we found on average in reporting season, as an example, out of the maybe 30 companies that we're following at that time, 2 or 3 will drop dramatically in price after they report, despite reporting a good report. Those are the 2 or 3 bargains that you get. You won't get all 30, but there could be some of the other 30 that are on such astronomic PEs, they're so expensive that the only thing you can think about when you think about them is bubbles. And just as an extra amusing thing, I'm sure pretty much everybody watching this podcast would know the very famous song, I'm forever blowing bubbles, pretty bubbles in the air. That wasn't written for kids. They fly so high, they nearly reach the sky. Then, like my dreams, they fade and die. Fortune is always hiding. I've looked everywhere. I'm forever blowing bubbles, pretty bubbles in the air. That was written about financial bubbles. I'm forever blowing bubbles. The market is forever blowing bubbles, pretty bubbles in the air. They fly so high, they nearly reach the sky. Then, like my dreams of wealth, presumably, they fade and die. Those ones didn't pop. They faded away and died. Fortune's always hiding. I've looked everywhere. I'm forever blowing bubbles, pretty bubbles in the air. So this is not anything new. They were singing songs about bubbles 100 years ago, because that song's roughly 100 years old.
Wow.
And, books were written. There was a book written, The Mania of Crowds, before they called them bubbles. That's also a long, long time ago. It was written in, I think, if I remember correctly, in the late 1800s. But we can go back much further even. China, when it was the biggest economy in the world, before the Mongols conquered China, it became the biggest economy in the world under the Mongols too. But even before that, before the time of Kublai Khan, who was a Mongol emperor in China, China had times of massive inflation. China had times when there were asset bubbles and farm properties went up dramatically in price, and times when they crashed. So it's not new. The Romans had them, the Persians had them, the Egyptians had them. They, throughout history, they didn't necessarily call them bubbles, but they were the same sort of thing. And they're all caused by human behavior. It's human emotion that causes it. If we were all 100% rational, and I'm not suggesting for a minute I'm always 100% rational, if we were always 100% rational at all times, there'd be no bubbles. But there's nothing that excites people more than seeing their neighbors getting rich.
Yeah.
They have to join in. It's this fear of missing out. And then when it crashes, it's the fear of getting out. So everybody runs away. And those are the sort of things you get where the people queued outside banks to get their money out of banks.
Oh my goodness. Well, thank you, Howard. That has just been such an interesting conversation. And as humans, we are so weirdly amazing,
But
and we always have been.
absolutely. And it's wonderful to be. And, if you're a thinking investor, bubbles are wonderful because you know what's going to happen next.
Yeah.
And during the bubble, you know what you should not be investing in and what you should be investing in.
Yeah.
It's the dumb money that loses. Warren Buffett, just a final comment on this, Warren Buffett once made the comment that stock markets, or it maybe even been his mentor, Ben Graham, stock markets are a wonderful place for transferring money from the foolish to the wise. And that's usually what tends to happen, unfortunately. You'd like it not necessarily to always be like that, but it is.
Absolutely. And look, through this episode today, Howard's spoken multiple times around Teaminvest and our investment philosophy and how we research the companies that we invest in, which becomes even more important when we're in the time of a bubble. And if you would like to learn more about Teaminvest, jump onto our website, teaminvest.com.au, subscribe or reach out to us. We'd love to help you and give you more information about us.
And in fact, it may be even worth adding on at the end of that. And there are two main ways in which you can benefit out of being involved in some way with Teaminvest.
Absolutely.
One is a member where you educate yourself to be a better investor and you become a better investor in the process, running your own money. And the other, if you don't have the time, the energy or the inclination, we have funds which run on the same principles that can help you at the same time.
Absolutely. So please reach out to us and please share this podcast. If this is, tweaked a nerve with you or you found it really interesting or you know somebody who could really benefit from listening to this podcast, please share this podcast. But thank you, Howard. Appreciate your time today and your wisdom. And thank you for joining us. The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.